So do you want to retire but don't have as much money as you would like? Or maybe you just have a lot of savings that you want to start using to generate a side income so you can spend more time with your family and less time at work? Well, if you use the strategy I'm about to teach you in today's video, you'll be able to make a 2.25% return every single month, regardless if the market goes up, down, or sideways. That means that if you're trading with a $185,000 account, you'll be able to make $50,000 a year in consistent income. Now, let me show you exactly how that works. Also, after I share this strategy, I'm going to walk you through my exact risk management rules and strategy that's going to help you not blow up your account or experience large losses so that you can actually do this consistently and safely in retirement. So if you're ready to stop worrying about retirement or want to learn how to use this strategy to generate a side income, then smash that subscribe button and let's get started. So this strategy is called a credit spread strategy. If you've never heard of it, it's quite simple. It's simply betting that a stock will stay above a certain level. So let's say they have a stock trading here. Our bet is that the stock will stay above this level. As long as the stock stays above it, we make money. So that means if the stock goes up, we make money. If the stock stays the same, we make money. If the stock goes down but stays above our level, we make money. The only time we lose money is if the stock goes down below our level. And if you stay tuned till the end, when I talk about my risk management rules, I'll show you how to take your losses and massively shrink them. Anyways, so let's walk through how this strategy works. So essentially, we're betting that a stock stays above a certain level, but how do we structure that trade? Well, essentially what we do is we're going to sell a put option and then buy another one below it. So let's say the stock is trading and we think it'll stay above this level right here. Well, we're going to sell this put option. Again, I'll walk you through this and a broker here soon. And then we're going to buy another put option. Why do we do this? Because when we sell a put option, this allows us to make money as long as the stock stays above this level. But that also gives us an infinite amount of loss. And we don't want that amount of loss, especially in retirement. We're trying to keep things safe and conservative. So what should we do? Well, we should buy a put option below it. And this is going to cap our losers so that we have a smaller loss. But instead, it's also going to cap our winners. Regardless, this is how you structure a credit spread trade. You sell a put at the level you think the stock will stay above, and you buy one below to create protection and to create the credit spread. Your next question is probably, okay, this is cool, but how do I know what levels to pick and when to put on these trades? Well, let's walk through that using tradingview.com. You need access to a charting platform, whether that's through your broker or online. I'm using tradingview.com because it's a free site. But anyways, what you want to do is you want to go to the indicator section, go on to moving average and add a moving average simple right here. Some call it a simple moving average. Once we do that, we're going to go into the settings of this and we're going to change the length. Length of 9 means that it looks at the last 9 candles to generate this line. Well, we want to go out a bit further. Let's put 50. We can either use 50 or 200. Both of these work well. Let's actually use 200. Okay. So this shows right here what the stock is doing. If the stock that we're looking at is above this 200-day moving average line, then the stock is bullish. If the stock's bullish, that's when we're going to bet that the stock stays above a certain level. If the stock is below this, we're going to do the opposite, and we're going to bet the stock stays below a certain level. So for instance, if the stock is below, then we'll bet that the stock is going to go down in general. If the stock's above, we're going to bet the stock's going to go up in general. That's how we put on these credit spread trades. So after we know this, now how do we structure what levels to pick? How do I know what level to pick and have a high win rate to make money with this? Well, simply follow this formula. You take wherever the stock is trading now, you take the close price. So right here it says 445.99. Let's just round up to 446 for easy numbers. So we're going to go 446 and we're going to multiply it by 0.97. So 0.97. Okay, cool. This means that we're going 3% below the stock price. This is a really great level to use for credit spreads if you want to be super safe, which is what we want to do. So right here it shows a level of 433. So again, you can also, to be a bit, if you want to make a bit more, so what we do is we simply take where the stock has recently closed for today. So for instance, it says 445.99. So we'll just round up to 446 for easy numbers. So we're going to go up and say 446 and we're going to multiply it by 0.97 or 0.975. Let's just say 0.975. Then round up to the nearest whole number. This means that we go out about 2.5% or roughly 3% below the stock's current price. So that gives us some margin of safety, which I'll explain here in a second. So that means that the level right here says 434.85. So let's round up to the nearest whole number. So 435. What does this mean? This means that we want to place our level at 435. So let's zoom in. Where is 435? Let's add a charting to this table. So 435 is right here. So let's take a look, 435. So right here, that means that we're betting that the stock will stay above this level. 435 is the level. Now, like I said, to structure a credit spread, we have to buy one right below. So it's going to be something like this. So this is how we structure our credit spread. As long as the stock stays above this level, we make money. Now, how much money are we going to make and how do we place this on the broker? Well, let me walk you through exactly me placing it on Robinhood right now. All right, well, you can use any broker for this, but I will use Robinhood because it looks super easy and it's very user-friendly. So I'm going to type in SPY, which is one of the best things to trade credit spreads with. So the strategy, please use SPY. Again, you can use others, but SPY was one of the best. Then go here into Builder. Click on Put Credit Spread. Again, it's a put credit spread if the stock is currently above that blue line that we mentioned. If it's below and we're betting for the stock to go down, then we'll use a call credit spread. But for this one, since it's above, we're going to use a put. So here we're going to go to a proper distance. That's going to be roughly 10 to 18 days, somewhere in there. So for this example, we'll do 10 days out. So you can see 10 days right here, September 22nd. Next, we have a width of 1. And then we pick the level we found. So we discovered 435 was our level. So if we scroll down here to 435 right here, it's currently trading at 12 cents or 11 cents, 12 cents, something like that. Now, your goal is to collect from around 12 cents to 15 cents. That's the goal. If you can collect between 12 and 15 cents, it's a good trade to put on. So what does credit mean? What does it say here when I have a 11 cent total credit? That means the money they're going to pay you to put this trade on. Remember, this is a bet. You are betting someone. So they're going to give you $10 if you're right, and you're going to have to pay out if you're wrong. So we'll explain that here in a second. But essentially here, your max profit is 12 and your max loss is 88. So what does this look like? This means that when we're right, we're going to make roughly $12. When we're wrong, we're going to lose about $88. Now, when we're using this line, aka the trend, to follow and put on a credit spread with this type of level, we're going to have around a 90% win rate. So that's really good. That means 90% of the time we're going to make $12 and 10% of the time we're going to lose $88. Okay, cool. But also I'm trying to do this in retirement. I don't really want to lose $88. It's a lot of money. Why? Well, because if I'm only making $12 for winner, I'm going to need like 5-6 winners to offset just one loser. Okay, so how do we do this? This is where my risk management strategy comes into effect. So let's do this together. The risk management strategy is a stop loss, but where is our stop loss put? Well, like I said, a credit spread is a bet that a stock will stay above a certain level. So if the stock will stay above this level, then how do we know when this bet will not work out in our favor? Well, maybe when the stock breaks this level. So that's our stop loss. When the stock breaks below our main level, so for instance, for this example, 435, when the stock gets below 435, we're going to stop out of this trade. So typically, if we let a stock go below our level and it expires expires in the money, then we're going to experience this max loss of $88. But if we exit when our strike price, or 435 in this example, is broken down below, then we're going to exit at 50 cents. When a stock breaks its strike price, it's trading at half the width, so 50 cents. It's just math. Okay, so that means that if we get $12 to put this trade on and we're going to exit at 50, what's the difference? That's $38. So that means when I win $12. And with the stop loss risk management rule, again, that's not it of the risk management, that's just our stop loss, is I'm going to experience a $38 loss. Again, with this, I'm going to have roughly an 85% win rate. So 85% win rate, you're going to make 12, you're going to risk 38. Is this a good trade to put on? Absolutely. You should be taking this trade every single day, but I want you to have confidence and know why. So let me explain the math. This is the math of long-term expectancy. We take the amount of times we'll win times the amount we win minus the amount of times we'll lose minus the amount we'll lose. So let's do a simple example. Let's say with this setup right here, we take 100 trades. So out of 100 trades, we have an 85% win rate. That means we're going to win 85 times. How much do we win when we win? Well, in this example, we win $12. Now, if we have an 85% win rate and we take 100 trades, how many trades will we lose? We're going to lose 15 trades. How much do we lose when we lose? We lose $38. That's a positive return of $450. That means out of 100 trades, if you took the 100 trades in a row, which is about the number of trades you'll make in a single year, you'll end up with $450 of profit, and that's off one spread. So one spread for the year. Why for the year? Because you should be taking two spread. I'll break this down in a second. One spread is going to equal $450. Now, why is this? Well, like I said, 100 trades. Now, why? Because your rule every single week should be to put on 2 trades. Put on 2 of these trades. If you can put on 2 of these trades every single week, then you'll be able to have monthly reoccurring income. Why? Because every week you'll have something reaching a credit spread reaching expiration date, and every single time you do that, then guess what? It's amazing because you have monthly income, or I should say weekly income, coming in. And so if you do 1 spread per trade, so you're doing 2 spreads basically a week, 1 spread trade, 1 spread trade, 1 spread trade, then you'll make $450 on average in 1 single year. So what happens when you have a large account like a $185,000 account? Well, now let's talk about my second part of my risk management rule, which is sizing. What should your size be? You should exceed no more than 3% of your portfolio. Now, why is this? So, how much should we risk on a $185,000 account? Well, for consistency and growth, we should risk no more than 3% per trade. If you want to risk less because you want to be more conservative, that's fine. And you can do the same numbers here. Simply, we take our total account value, $185,000, times 3%, and then we do the math here. So let's walk through this. I can't do that math in my head, so 185,000 times 0.03 gives us $5,550. Wow, that's a nice number. $5,550. Cool. Okay, now to put on 1 spread, it takes $100. So we're going to divide this max loss by $100 to figure out how many spreads we should be in 1 trade. So simply we're going to move the 0 a couple times. We're going to get about 55 spreads per trade. This is a safe way to trade, 55 spreads per trade. This means that if we extrapolate this out, we're going to be in 55 spreads for 1 single trade. So if we take this data here, how much do we stand to make for each trade versus how much do we stand to lose for each trade? Well, let's quickly do the math. If we have 55 spreads per trade and we make $12 per spread, that means every single trade will make $660. And like I said, your goal is to what? Put on 2 trades a week. So if you have 2 trades expiring every week and they make money, that's $1,200 in weekly income that you get from doing this. Now, what about our losses? Because we do have to factor that in. I'm going to stand to lose $2,000 on a single trade. So yes, my loss is way greater than my win, but that's because I have a really high win rate, and that's what I can do. We want consistency, but we will have those bigger losing months. But again, with the stop loss, it's still way better than what it would have been. So that's how we do that. Again, that's with a 3% risk per trade. If you want to risk less, like 2% or even 1%, that's fine. But let's show the math on a yearly return using 55 spreads per trade. So that's going to be, because 1 spread is $450 for a total return for the year. So that's simply going to be our total number of spreads, 55 times $450. That's a total return of $24,000. So if 1 spread equals a $450 return by the end of the year, then if we see what we're doing with 55 spreads times 450, that gives us a basically $5,000 return for the year. So 25K return for the year when we factor in profits, losses, and everything when we risk 3%. But now let's walk through some numbers. What happens if you only risk 1? What happens if you risk 5? Anything like that, let's walk through it. This is a tool for my members called the Predict Your Future Performance using our previous alerts. The exact strategy that I just walked you through has been back tested, and I've been trading it for almost a year now. And again, we have all the back tests here since 2000 and I think around 10. And so because of that, we can see the data here. And so if we risk 3% per trade, we can see what we're doing. Again, we're going to plug in an account value of $185,000, and we can see what our growth would have been. So that would have given us a 27% annualized return, and that would have been roughly what we would have made. But again, if we want to actually bump that up and let's say make $50,000 a year, then what we need to do is do a 5% return. Now we're going to be at roughly 49% return for the year. So we have $185,000 and we have a 49% return for the year. That's almost a $90,000 return every single year. So what happens if we make that a 4% return? Well, that's going to be roughly a 38% return. So what's 38% return a year off of this? That's a $70,000 yearly return. So again, we can kind of play with these numbers and what works best. Again, if you're trading and you risk 3%, you're going to have a 27% annualized return. So that's going to be roughly $50,000 a year. But again, what if we only do 2%? you'll be looking at roughly an 18% return a year. So again, all this still beats the market. It's all about how safe and consistent you want to be. Regardless, if you're trading with $185,000, you can use it to retire. Is it the safest? Absolutely not. You should be trading with more. You should be trading with maybe 200, 250. I would say that's a safe borderline. Again, the more, the merrier. In retirement, you don't know what expenses are coming up and what has to be paid for. So the more you can trade with, the better. But on a bare minimum, if you really want to get by, you could do it off $185,000. If you want to learn more about credit spreads trading and how I do it in my exact strategy, I have a free course link down below that will walk you through every single strategy I use for every different type of market to have a really high win rate and to lower your losses and make greater returns. Anyways, that's down below and linked for free. Anyways, I'll see you in the next video.